Humanity moves dangerously closer to the edge of the world. Martin North, John Adams, in the Streets of People. Hi, John.
Hello, sir.
Back again. We're getting close.
We are definitely getting closer. We've had a tumultuous week across the world in terms of financial and economic news, and we are seeing a lot of action around inflation, around interest rates. A lot of very interesting things in China, I must say. I've never seen a nationwide strike to pay the mortgage, but that's happening in China, and that's obviously a new form of protest movement. But potentially, maybe Australia should take that up as well, to send a message to the banks and the RBA, maybe to the RBA governor. You screwed us over by raising rates too early. We're not going to pay the mortgage, and we're going to sort of bankrupt the system. So very interesting things in China, and we've got a lot to talk about. But the key message that we're going to cover today, Martin, is we are getting close to that point where these rate rises around the world is going to break something, and it's not just going to break it in the crypto market, but in the broader financial system. And the big danger for our viewers and people across the world is, will this result in some sort of big institution, some big government, some big bank, either going into some sort of liquidity crisis or a declaration of a default credit crisis? And if that was to happen, given that the debt bubble is much, much larger than where we were in September 2008, we could see a new global financial crisis. So we are moving closer to that point. And I guess the big concern I have is that central banks, whether it's the RBA or other central banks, probably don't have a good gauge as to how high can they raise rates to supposedly fight inflation without breaking the system. So we're getting closer to that point. Now, will they break the system? Will we fall off the edge of the world? Or will they be able to find where the edge of the world is and pull us back? That's going to be the big question over the next 4 to 8 weeks, because the rate rises this week were, it not only just surprised me, it surprised the markets as well.
Yeah, there's a lot going on this week, and I guess it's interesting, of course, the Fed is now definitely saying 75 basis points next month. The market was at one stage saying 100 basis points or 1%, and we had other rate rises from other places. And you're right, they're focusing on inflation, right? They're saying inflation is the thing they've got to crush. But of course, they're not lifting rates anywhere close enough to really crush inflation at the moment. So there's still a long, long way to go. And as you say, something's likely to break in the process.
Indeed. So let's start the conversation with the United States, because that's obviously the epicenter of the financial system. So this week we saw that official inflation was, in terms of its annualized rate, went to 9.1%. So that was obviously higher. And again, the reason why this is important, Martin, is that, initially we had no inflation, temporary inflation, transitory inflation, and then it was that we had hit the peak. The economy wouldn't go into recession, and all the way through the statements from Jerome Powell and others, they have been falling flat. So only in the last few months did they say inflation had peaked. And then when we did a show about the markets last month, when we hit 8.6, the markets were quite upset that inflation had not peaked then. We're still going higher, and we'll obviously have to see how the rest of July goes before we get the July number in terms of August. But 9.1, the markets reacted negatively on the assumption, like you say, that they thought that interest rates would go up on the 26th and 27th of July by 1%. The Federal Reserve has tried to calm that talk down, so no, we're going to stick to 75, so we'll have to see what happens there. But the key manifest of this inflation and interest rate expectation movement was the inversion of the yield curve. Now, you and I did a detailed show back in 2019 on the 15th of August, and that show was called Australia is One Step Closer to Economic Armageddon. And so we actually went through the history of the yield curve, why it's important, and what has happened with this inversion of the 1 to 10 year yield curve and look over the last 40 or 50 years. So if anyone who actually wants to understand that from a more technical academic perspective, potentially go back and have a look at that particular episode. The one thing I'll say in the context of this time around, so typically the 1 to 10 ratio inverts, and then you have the recession. In this case, what we've been saying, and this is based on the data from the Atlanta Fed, the recession has actually happened before the inversion of the yield curve. So potentially, given that there's so much intervention in the bond market, maybe its predictive ability has been manipulated by various the U.S. Federal Reserve and various interventions. But if anyone's in any doubt whether we're going to have a recession or not, the GDP data is saying 2 quarters of negative growth, and now we have the bond market saying, we're going to have a recession. The recession is going to basically continue. So the bond market is also confirming that. And obviously, we're going to see, as the economy continues to weaken in the US, interest rates are going to go up 75 basis points at least in 2 weeks. And then we'll obviously have to see what the expectations are for their September meeting, given that they don't meet in August.
And I just mentioned the Atlanta Fed, of course, they're now casting on the GDP, but they also have this other thing called the Taylor chart and Taylor curve, and that's what's trying to get at what is the right rate that you'd need to get to in terms of interest rates to really control inflation, right? And that model that they also run is saying it's got to be a lot higher than anybody's thinking about at the moment. In other words, the rate of increases that we're talking about and the Fed is talking about will be insufficient to crush inflation, which is quite concerning.
Yes. I mean, things like it. So we have people like us who are contrarian, economists, financial experts like yourself, who basically say that this is not a real fight against inflation because the interest rate, the nominal interest rate, has to be above the inflation rate. So if we're at 9.1 now, the interest rate has to go to about at least 12%, 11 to 12%, just to give yourself a positive real interest rate so that inflation can come down. Now, this Taylor rule doesn't take their projections on interest rates as to where it should go, isn't saying 11, 12% in terms of the interest rate, but it is saying that it should be around 7, 8%. But we're only at 1.75, and the U.S. Federal Reserve Committee has sort of said they're looking at about 3.5. So even their own internal technicians are saying what the board is projecting to the market is insufficient, and that's obviously a worrying sign. So it'll be very interesting that when Jerome Powell comes out in 2 weeks, whether he'll actually address the work of his own Atlanta Fed, and whether he's willing to say, well, maybe we have to revise up our interest rate projections given the technical work around the Taylor rule.
And one other point, of course, is the argument now is a lot of the inflationary pressure is being driven by things like oil prices and other commodities. Now, the wheat price did come back a bit. The oil price has come back a little bit. So the question is, will that actually then start to top out, the inflation numbers? But of course, the other point there is that things like rents, which are still going up dramatically here and in the US, are still to flow through properly into the inflation numbers. So not all the elements that make up the inflationary lifts are necessarily at their peak even now.
Yes. So basically what you're saying is there are some parts of the CPI basket which are still going up aggressively, and then there are other parts like commodities. Now, commodities are going down for 2 reasons. One is that because of these rate rises, there's an expectation of softening demand, so that's why some of the prices have come back. And even if you look at oil, the oil price has gone back to the pre-invasion level. But the other thing is that even when I looked at Bloomberg News in the last hour, they're suggesting that some of these supply chain bottlenecks are starting to ease as well, even though that the war in the Ukraine is still continuing, and that those supply chain bottleneck situation is going to give further impetus for prices to come down. So it could well be that in the next couple of months we may see a slight dip in inflation in terms of the annualized rate. But the question is, even if we see a small dip, does that mean that the fight has been won, or or is the real fight is that they need to get back to target, which is 2%, according to their own statements.
Yeah, and of course, John, there's still the services inflation, which is still quite strong at the moment, and that a lot of that is driven not by externalities, but by internal repricing within inside economies, and we're seeing that strongly here in Australia and in the US as well.
Yes. So now moving on to the big announcements around interest rates. So there was multiple central banks across the world that raised interest rates quite aggressively this week. So I think in a post that you've done for DFA, you talked about the Reserve Bank of New Zealand raising rates by 0.5%, taking it to 2.5%, and that's going to add more ammunition for the property sector to property prices in New Zealand to go down even further. And then on Wednesday night we saw. So that happened actually on Wednesday during the day, and then on Wednesday night, the in terms of the Bank of Canada came out with a full 1% increase. So they've gone to 2.5%. Now, before we go on to some of the other countries, one thing I will say, just in terms of how the RBA may think about what they need to do, is so you've got the Western. When you look at Western Five Eyes central banks, Five Eyes economies, you've got New Zealand and Canada now at 2.5. United States at 1.75, saying we're going to go to 75, which is basically to 2.5. And the RBA's lagging behind at 1.35. Now, because we are lagging behind, and given our last episode where we talked about the importance of the foreign debt and stabilizing the Australian dollar versus the US dollar, that's why we've had Deutsche Bank and some other voices in the market saying that their expectation for the 2nd of August is that the RBA will raise rates by 75 basis points, not 50. Now, CBA is saying that there'll be 50 in August, 50 in September. So it's a very interesting thing, but the Australian dollar is going to be a big factor in moving forward because Philip Lowe left it too late, and now these central banks are being more aggressive than 0.5%. And the question is, can he catch up? But the other big concerning thing, Martin, this week was that South Korea raised interest rates by 0.5%, and this is the first time in South Korean economic history that they've raised rates by an actual 0.5%. So when I was reading this, I was thinking, well, I mean, 0.5% doesn't sound like much, but they've never done it before, and they did it this week. And then we saw now. Even though we had that, what is perhaps even more interesting is out of cycle rate rises. So when you hear economists talk about in cycle, it is that they're raising rates at their scheduled meetings, and when they raise rates or cut rates when between meetings, that is what they call out of cycle. So we saw the Philippines raise rates by 0.75% this in terms of the past week, which was no scheduled meeting, just a surprise out of nowhere that they raised rates, concerned about about the surging US dollar, but also in terms of potential inflationary pressures in Asia. And then we also saw Singapore intervene as well. Now, we were having an interesting discussion off camera about Singapore. Singapore is perhaps one of the only central banks that doesn't actually target interest rates when it says its monetary policy. It actually focuses on the exchange rate. And so as the US dollar has been rising, the value of the Singaporean dollar has been falling. And so they've said, well, we're going to lift the value of the Singaporean dollar so that it stays at its target range with the American dollar. And so by doing so, domestic interest rates are going to go up in Singapore. Like I have to say that one of my contacts in the last couple of months has bought property in Singapore, and one of the observations when they were looking for property in Singapore was that Singaporean property is actually more red hot than the Sydney property market. So that is a interesting observation. So if you've got a big sort of surge of demand in Singapore and now interest rates are starting to go up, we could start to see problems in the Singaporean property market going forward.
Absolutely. And these things, of course, tend to have a sort of a echoey effect, right? So everyone looks at everybody else. The strong dollar is something just to pause on, right? Yeah. So the dollar index is above 107, right, knocking on 108, which is the strongest it's been for a long time. Having, of course, a significant impact on the commodity prices, right? Iron ore commodity way down. It's 107. It's roughly the same as it happens to be. So there are these big movements, right? And so trying to actually get some control in all of this I reckon is quite complicated for a lot of the central banks. The question is, of course, will they solely go after the inflation target, or do these other factors like the exchange rate come into play when they try and work out what to do? But with the inflation running so hot, you'd have to say they're going to focus on lifting rates higher, surely.
Well, yes. So I think they are in the next, and when I say the short term, I'm talking about the immediate term. I think in the next 2 months, they're going to continue on with these rate rises. But how much further can they go before you start to see some sort of announcement that a company has gone broke? Yep. And again, it doesn't take much for, in terms of a small snowflake to turn into a huge avalanche.
Yeah, and let me make one other point. You mentioned CBA. CBA has been the laggard in terms of their forecasting higher rates. They've tended to go behind the other banks. Now Westpac's talking, but CBA is now talking about a peak rate of 2.5, 2.6 or something. So CBA has now got more aggressive in terms of rate rise. That's quite interesting and quite significant, I think, as well. That pretty much everybody now in Australia is saying rates are going high.
Indeed. Now, we haven't spoken a lot about China, Martin, but China is actually a very interesting case study, potentially for a couple of reasons. The first one is that while the world has an inflation problem, inflation is not running particularly out of control in terms of China, according to the official Chinese statistics, which some may say can't be trusted. But if we're going to accept what they say, so they have said that in the 12 months to June, inflation in China has been hitting around 2.2%. Now that is at a 2-year high, but it's nothing like the other sort of parts of the world. Now the other interesting point is that interest rates in China technically is above the inflation rate. So the 1 year interest rate which they focus on is at 2.85%, and inflation in China is 2.2%. So whereas most of the world has had negative real interest rates, in China, according to, if we are to believe the Chinese official statements, they have positive real interest rates, and that means that they should be able to relatively contain inflation. But now the other thing is that in the last few months, with COVID raging across China, the Chinese authorities have reimposed COVID lockdowns quite aggressively. And that has actually resulted in the second quarter of 2022, the Chinese economy shrinking by 2.6%. So on an annualized basis, the Chinese economy grew by 0.4, but for the quarter, it shrank by 2.6. Now, we are seeing, obviously, the American economy in recession. The last quarter of New Zealand was negative. Now we have had a huge set of issues in the Chinese property market, particularly with Evergrande. On top of that, you've got in terms of the issue of COVID, and now you have you've got in various provinces runs on banks, but also you have now developers unable to meet their construction timelines. And you've got a whole host of property owners, investors are saying, well, I don't have my property. No one will listen to my grievances. I'm just not going to pay the mortgage. And we're going to go on a nationwide mortgage strike. Now, even though it's, according to what I saw last night, 86 cities across China, 230 projects, when you look at the relative scale of the Chinese economy, it's still a drop in the ocean. But over the last few days, this movement has been growing exponentially. It will be very interesting if that exponential growth in protests gets to if it continues to grow, because I'm not sure where the critical mass point would be.
No, and it's interesting. A few commentators are now saying that we've actually got to the point now where rather than those mortgage non-payments hitting the property company themselves, they could be now sufficient to start putting pressure on the financial system as well. And so if it does grow and develop, and it's been through social media that's actually been a movement that's sprung up from almost nowhere, it could have a significant impact on the financial system as well, which of course was interesting because the Chinese authorities reduced the capital requirements for the banks a few weeks ago to try and give them more headroom. So the question then is, well, how stable are the banks in China? Some of them look a bit shaky at the moment. This is yet another indicator of trouble ahead potentially.
Yes. I mean, there's been a number of moves by the Chinese authorities. So in May, policymakers looked at this 5-year policy rate, and they actually reduced those interest rates. They've loosened some capital standards. Earlier in July, they announced an unprecedented, I think it's a $220 billion program where they're going to go out and try to issue bonds early so that they can provide more stimulus. And then on top of that, and here's what I think is quite significant, Martin, is that official spokespeople from the IMF has actually now asked the Chinese authority to inject stimulus to try to get its growth rate up. So if anyone is wondering what do the international institutions want, they don't want deflation, they don't want a financial crisis, and even though we have inflation around the world and everyone is tightening policy, the IMF is actually saying the opposite to China, saying we want you to produce more stimulus because, as Harry Dent has said, even though we've got this big global debt bubble, the biggest national debt bubble, if you look at the economy in its totality, is actually China. And if the Chinese property sector was to collapse, that would result in financial crisis in the Chinese banks, and that would be systemically significant enough to bring the entire global economy to its knees. So obviously the IMF is very nervous about China blowing up and that resulting in a catastrophic global event.
Yeah, and of course with all of these things, it's all interconnected, right? Because of course a lot of the bonds are actually connected to the US economy and other economies too. So if things wobble in one place, it can spread. And of course, bearing in mind that we have very strong exports to China, 37% of ours go to China at the moment. So if they turn the dial down there in China, and if the economy continues to go off the boil, that could put a significant pressure on our local economy as well.
Yes. One of the other things, Martin, is that in the last few days, since we did our last show about Sri Lanka, I actually have had a conversation with Dr. Peter Brain, who wrote the book Credit Code Red. And one of the concerns that, and hopefully we'll be able to bring him on the show, hopefully in the next 2 or 3 weeks. But one of the things that he expressed concerns about is about whether Australia has enough foreign exchange to meet our foreign debt obligations is that if our trading relationship was to sour with China for whatever reasons, whether it's political or if it was to be about the economic factors that you considered, our ability to generate enough foreign exchange, but given how dominant that trading relationship is, that could really spell some big problems in terms of the Australian dollar, and it could potentially impact monetary policy quite significantly. So the China issue and how that the Chinese economy and how that impacts our trading relationship could have a huge issue about our ability to raise foreign exchange, and that would obviously lead into some of the comments that we made in our last show about the Sri Lankan situation manifesting here in Australia.
It is interesting that the LNG exports is actually supporting our trade with China significantly now. They're actually taking an awful lot of it, and it's actually overtaken several of the other exports that we used to throw out there in terms of actually the absolute proportion. So it'll be very interesting to see how this plays out. But again, there's so much instability in this whole sort of network of relationships, isn't there?
Yes. Now, one of the things that we have been talking about over the last 1 to 2 months is about, as you raise rates, you are going to see some carnage in various parts of the financial markets. And we've seen, obviously, asset prices across the board fall down. Some commodities have fallen as well. But also, we've seen some horrendous damage in the crypto market. And we've seen in the last 24 hours, Celsius Bank, which we've talked about previously, has officially filed in terms of bankruptcy, and they still owe their investors about $4.7 billion US. Now, in total, their liability is about $5.5 billion, and News.com has a very interesting article about it. But when I actually had a look at the balance sheet, some of the assets that they actually have, which are supposedly there to meet some of these liabilities, they have been overinflated. So I think the real losses for these investors who are involved in Celsius Bank, or the depositors, given that it's a bank. One of the interesting things, Martin, is that the crypto market, which has really come to the fore in the last sort of 5-6 years. I mean, yes, we've had Bitcoin, but now we have almost 20,000 different crypto projects across the world in terms of these various tokens, etc., and exchanges. We probably haven't seen the aggressive interest rate rise campaign that we're seeing now, and so we've had a few institutions in the crypto space break, and it'll be very interesting to see that as we move forward over the next 4 to 8 weeks, whether there's any other big sort of shock announcements. The one I'm looking for is Tether. A lot of question marks about, do they actually have all the US dollars that they claim to have to back the stable coin? Because if those concerns in the market do eventuate, a lot of exchanges are going to collapse, and the price of Bitcoin could fall quite heavily. And Tether's relationship in the market is why some people are forecasting Bitcoin to hit about $12,000 to $10,000 US. So these aggressive interest rate rises, it's going to break something. It's going to cause some financial damage for investors, and people need to be very careful about how they position themselves over the next few months. But the question, if we're to bring this show to a close, Martin, is the big question is, will they go to the edge of the world and push us over into the abyss? Will we break something so big that the genie's out of the bottle and we can't put it back into the bottle, and that we have a full-blown financial crisis? Or will they get close and realize we can't go any further and surrender to inflation? So we've obviously said in previous shows, Japan, the UK, and the European Union have effectively surrendered to inflation because they are doing nothing remotely like the other central banks. But the central banks that are, trying to put up a supposed fight, whether it's the US, Australia, Canada, New Zealand, South Korea, and a few India, and a few other central banks, will they continue this march towards a financial crisis, or will they stop? And that is the big question in the financial markets and in global economics. And it's a very interesting dilemma that policymakers have. And obviously, I've put my cards on the table. I think they will pull us back from the abyss because they are too afraid of the consequences. But given that they don't really have real-time data, there could be a significant policy miscalculation. And even though they may not intend to cause a financial crisis, they may actually accidentally break it and say, oops, I'm sorry.
Well, yes, and again, I keep coming back to this highly interconnected set of things that are going on. And just to give you one example on the Celsius issue, right? If you start looking at who actually is on their list of people they owe money to, it's a lot of other big crypto players. So they're all interconnected, right? And I actually think that's a microcosm of what we were seeing elsewhere. In other words, a lot of the financial system is connected with other bits of the financial system, and the financial planning runs around the world. So, if you're turning a dial over here in one country and trying to do something on inflation, you're not quite sure what the complete story is to how that impacts something over there, right? This complicated network that we've created, I'm not sure anybody really fully understands it. And I remind you that the repos was actually what turned the Fed back a few years ago when they started doing their quantitative tightening. And of course, the Fed has just started quantitative tightening now, and their balance sheet is just tipping down to a slightly lower position. So the chances of them breaking something, I think, are extremely high.
Yes, absolutely.
John, appreciate your time today. Thank you very much for that. We'll talk again soon.
Absolutely.
Martin North, John Adams, in the interest of the people. We'll see you next time.